Right, guys, hello. This is 5 ways to prepare your portfolio for a recession. Right, guys, typically when interest rates rise, especially by these dramatic amounts that we're seeing, typically within 12 to 18 months, we see a recession. Typically, a recession is defined by 2 consecutive quarters of earnings decline market-wide. However, when we last saw this, we then suddenly got earnings bouncing back dramatically and very, very quickly. However, with Tesla missing earnings in Q3 recently, with the rising cost of interest rates making the monthly payments on cars less affordable, which in turn made Tesla decide to slow down its production of its Mexico factory, which in turn will mean less money going into the economy, perhaps we are finally reaching the point where the Fed raising interest rates is affecting the wider economy. In short, this would mean we are heading into a full-scale recession soon. However, when we tried to learn from the past in order to best decide what's the right move to make today, in many ways we are in uncharted territory. This current situation that we are now in was brought in by COVID-19, the war in Ukraine, an energy shock, and record low interest rates for years. So I want to do a video on how I'm preparing for this, as well as what investors like Warren Buffett, the greatest investor of the last 100 years, what he has done in the past during very volatile market conditions. I just want to clarify that I have had no formal education in finance and I am not a qualified financial advisor. However, in my opinion, all the best information about financing has been freely available for decades and is publicly available online. I think one of the best ways you can learn about stocks and shares is just going through old SEC filings and watching Warren Buffett's Berkshire Hathaway's annual general meetings that they host every year. I've been investing publicly since 2015 on eToro. You can just go there and check out my portfolio, or you can go to app.pi-screener.com and you can actually compare my performance to the market average. So you can actually see there that I have beaten the market by almost double in that time. I think the main reason that I beat the market during that time period was one thing I like to call the snowball effect. In my opinion, the snowball effect should be every investor's main goal. The snowball starts small at the top of the hill and eventually picks up more and more snow until eventually it's picking up more snow than you started with. This effect works best if you never touch the snowball. So rather than investing all your money into the stock market, try to invest in an amount that you never need to touch. Almost imagine this money as gone after it's invested. And in this analogy, a recession is just a really hot day. And even though it might melt your snowball a bit, so long as you don't touch it, when the snow comes back, it's just going to grow back faster and larger. Okay, so that is the snowball effect. Next is rule number 2. Cash is not trash. Guys, I cannot stress this enough. The biggest risk to your personal finances is your personal finances. To use a random company as an example, if Apple shares dropped by half, while this on paper looks bad, so long as you don't panic and sell, the most likely thing that is going to happen is Apple will use their massive surplus in cash to buy back shares on your behalf. And this will, given time, give you a larger stake and a larger dividend. This is almost exactly how we came out of the 2008 financial crisis so quickly. When the market way overreacted to a poor earnings season, the share price of everything collapsed, while the underlying businesses remained relatively unchanged. The issue for us is it takes a bit of time for the broader market to rebuild confidence in stocks and shares again, and prices to return to their previous highs. The big risk is while you're waiting for Apple's SEC filings to show that their earnings are recovering and that they have just bought back $1 billion worth of stock, your company potentially involved in the same market conditions goes bust, and you are left looking for a new job, and you have to close your shares in order to pay for your living expenses. The sensible thing to do here is to have a pile of cash ready for any unforeseeable event. In time, you may have assets that you can borrow against in a pinch, but until then, cash is your best friend at protecting you from poor short-term decision making. Okay guys, rule number 3, don't wait for a recession. One of the big mistakes I see people making is they think that they can time the market. So they hear a recession is on its way, and what they do is they pull all of their shares out of the market and wait for that recession to come, while Theoretically, this would be an amazing strategy with perfect 2020 hindsight. The issue is we just don't know exactly when that recession is going to happen. It's a bit like if you owned a house, if you tried to sell it at the top of the market, you've got to factor in that all the months you're waiting for house prices to come down, you're not collecting any rental income. So first, house prices might not drop at all, and then second, they need to drop more than what you would have collected in rent, and also they need to offset the taxes and trading costs. To give an idea of how hard it is to time the market, when rates dropped to 0% at the beginning of the pandemic, a lot of people predicted high soaring inflation and then a need for the Fed to raise interest rates. After all, rates couldn't go any lower than 0, so hikes were inevitable. The issue for these people applying the best possible logic and sense for pulling out of the market is that they missed out on one of the largest bull runs in history. However, when rates actually began to go up in 2022 and it looked like we were going to be coming out of the pandemic, again people thought, aha, this is the time that the markets will in fact collapse. And again, they were wrong. The market had another historic rise. Michael Burry, the guy who correctly predicted the 2008 financial recession and bet against the banks and made a massive profit off the 2008 recession, admitted that he got it wrong in 2022. The point I'm trying to make here is even though we think we have a good idea of what causes recessions, not even a supercomputer can predict exactly when they will happen. If you're interested, the issue here is there's no direct causational link between interest rates going up and share prices going down. It's quite possible that the fear of there being a recession is already priced into the share prices. Or that AI will come along and massively boost earnings for the big tech companies. After all, the biggest tech companies do not have to spend very much money at all to get huge earnings. They make incredibly large margins that are bigger than any other company in history. History has proven that the best funds do not give a shit about market volatility and only care about whether the fact that their businesses that they're holding are at a fair price. The best advice these funds offer is just be prepared for a 50% market decline in anything that you are holding. Okay, number 4 is a super quick one, bonds. Since I have the stomach to witness a 90% market decline, I like to have my money in stocks, and the remainder of my cash I like to have as freely available as possible, so bonds aren't something that I personally do. Objectively, this is a bit dumb. Essentially, I'm paying in unrealized returns for convenience. I don't think there's a lot to say here on bonds, but essentially right now short-term bond yields are extremely high, so if you do have a large amount of cash and you feel uneasy about it not being invested, maybe just buy bonds in the short term and just relax a little bit and do some more research before moving that money into stocks. At least if this money is in bonds, then no matter what the market does, you get the return advertised. The biggest risk when buying bonds is soaring earnings and soaring inflation, and I really don't think that in these conditions we are going to be seeing that. Right guys, number 5, the final bit of advice that I think is wise for anyone trying to prepare for market volatility is buy an index fund. And if you have monthly income, dollar cost average into it. No matter how confident I become as an investor, I am always dollar cost averaging into the VOO, which is the S&P 500. The S&P 500 invests in the 500 largest companies in America by market capitalization. Index funds have really low fees and invest in a broad spectrum of companies. So even if one of those companies or a few of them go down, you have the remainder of the portfolio holding up your investments. According to the Intelligent Investor from 2002, only 15% of mutual funds outperformed the S&P 500. The Intelligent Investor lays out guidance on how to find funds that are likely to be in this 15%, and you could invest hours in working out which companies, which funds are the ones with the best performance and the best management, or you could just buy the S&P 500. Mutual funds with brilliant minds don't just have to beat the market, they have to beat the market while charging you fat fees for doing so. Funds are also limited by the person running them. After funds do well, the management team is often then offered new job opportunities at bigger funds. Typically after they leave, so does their performance. And when a big crash smacks an index fund like the S&P 500, those 500 companies will work tirelessly while you sleep in order to return that value to you. While one or two or more might fall, chances are if an event comes across that wipes out the entire S&P 500, chances are your biggest concern is not finances at that point. It might feel like there should be a more sophisticated method for surviving a recession. However, even if there was a sophisticated method for surviving past recessions, in past recessions, prices weren't continuing to go up. And also, unemployment wasn't sitting at 5-year lows in those past recessions. And on top of that, GDP didn't just miraculously bounce back up and continue climbing after going down for 2 consecutive quarters. Let me put this more simply. If recessions were in any way predictable, there probably wouldn't be any, since most funds would react before the recession even happened. The only thing that we know reliably is that there will be a recession. We just don't know exactly when. And so while we might try to steer our ship away from big storms, we also need a ship that can weather storms and not simply avoid them. Right, I hope you found this video useful. If you did, please remember to subscribe and hit the notification bell and click the like button on the video. I'll be doing these videos weekly, so just let me know in the comments section if there's a video that you would like me to make. And yeah, thank you very much. I'm going to enjoy the rest of my tea, even though it's a little bit cold now. Thank you and goodbye.